All right, good morning, everyone. Thanks for calling in. This is our weekly S&P 500 Sector SPDRs preview. Just going to take a look at the different sectors that make up the S&P 500. This isn't really about trade recommendations. It's really just kind of a framework or a roadmap to what's going on in the markets. It's just good to take a look at these things because the media is consistently wrong about what's moving the markets, as are all the people that they have on CNBC and all these other channels. When I work, in the background I put on the History Channel or some Nature Channel because I can't take it. Like, for instance, what about last week? Trade war this, trade war that, trade war, markets are going to go down on trade wars, and I don't know, the S&Ps are testing close to an all-time high. They're testing 280. The all-time high was 286. So I guess now the trade war is a good thing. So here's the way I think about the markets. There are certain price levels that are more important than others with regards to the amount of supply and demand that exists at them. And financial markets prices are always doing one of three things. They're either going up, going down, or staying the same. So I've been a trader for a long time, for longer than I care to admit and remember. But you know, if you do the same thing over and over, you tend to get competent at it. Like when I was in college, I used to work for this guy. It was a real nice guy in this deli, and it always used to amaze me how he knew exactly how many loaves of bread there were, how many cans of this or jars of that, because it was a fairly big store. But as I got older, I realized, well, hey, you know, the guy's there 80 hours a week, so you know, you pick up something when you're there. As for these other techniques, such as Gann theory or Elliott wave or this, that, the other thing, I really just don't believe that stuff. I mean, in my years of being a trader, I've never heard a successful portfolio manager talk about that kind of stuff. But successful portfolio managers do care about levels and trends, because the levels are where the buyers and the sellers come out. And then the trends obviously tell you if things are going up or going down. All right, we'll skip this page. This is just a little overview. All right, so this is the really important thing to look at here. All right, you can see that the SPYs, the last three times they ran into the 280 level here, here, and here, they sold right off, and kind of a fairly big sell-off each time. So once again, we're testing that level, but however, there is a difference now. You can see here the market was overbought, here the market was overbought, and here the market was overbought. But here, where we are now, after a few days of consolidation, the market is not overbought. So, you know, you can see here that, that was Friday, Thursday, Wednesday, Tuesday, kind of traded sideways, and that kind of shook out the overboughtness, so to speak. So that could be a bullish dynamic. We'll just have to wait and see. But generally, when things hit important levels, if they're overbought or oversold, if they're overbought and they hit a resistance level, or if they're oversold and hit an important supply level or demand level, they tend to revert. But when they are not overbought or oversold, they don't. Like you can even see here, the S&P was oversold here, was oversold here. When I say oversold, I mean it's trading more than 2 standard deviations outside of its normal range, and that's represented by this line. So you can see that there and there. So the markets had a good week. Last week, they acted better than I thought they would, but we're at a critical juncture right now with this 280 level. So here's the tech sector. Got through this 71 level I talked about last week. Spent a few days consolidating. Now we're testing recent highs, which is the all-time high. So, I guess we'll see a little bit of consolidation here too, and it'll take a few days to figure out which way it's going to go. This is the biggest sector in the S&P 500. It's almost 30% of the makeup. So obviously it's going to be important to watch. All right, financials consolidated under this range for a few weeks. You can see that since back here in March, they've basically been trading between 2680 and 2835. And you can see again here too, like, see what I mean? They reverted here after becoming oversold. They got oversold here and then went into a big rally. got overbought here. So here, they consolidated and they became not oversold, and they got back up above this level, and they're consolidating above it. So going forward, just keep an eye on this level for support. And if they do rally, up here is where you'd have the resistance again, probably. And this is kind of an interesting chart. This is the financials going back to 2003. And you can see right before their recent sell-off, they were literally at exactly the same levels that they were back here in 2007 before the crash. So that's kind of interesting. Charts do have memories, or markets do have memories, and this is proof of it right here. I mean, this is 15 years later, and it turned over at exactly the same level. So ask one of your fundamental or academic friends to explain that to you, because they probably wouldn't be able to. I mean, think about it. Back here, interest rates were different. You had a different president. The price of oil was different, so forth, so on, and so on. And now we're here, and it's the exact same valuations of all the stocks that make up this basket of equities. All right, this is healthcare. You can see they got above this 86.50 level. There was a little bit of resistance there because it was your highs back here. Not too much movement here. You got to look at the scale. It's 82 to 92, 10 points. Well, I guess it's kind of significant if you own them, I guess, on a percentage basis. But I'd watch this 86.50 level going forward, see if it's support. If it breaks, this pocket here could get refilled real quick and you go right back down to 84. Here is the spiders, or sorry, the discretionary spider, the XLY. All-time high here, a little bit of consolidation here. Now it's uptrending again, but it is getting close, or it's really right at those recent highs. So probably going to have a little bit of resistance and consolidation here. If it heads lower, I would watch the 107 level for support. It was kind of support all through in here, was the tops back here, so that's why it became support. And it's also the level from which this rally started. So when you get a spike of a rally or a really, significant rally like this where it's up 9-10 days in a row, the level that it started at usually becomes an important level if it reverts. Industrials, you can see the 71 level. Once again, they found support and now they're rallying again. 71 was support here, and it was also support back here at the beginning of the year, and even here too. I mean, it's not an exact science, but this is in the 71s. So, within $1 of a $71 thing, it's pretty close. If they continue to rally, I would look for resistance up here. 76.50 was resistance here, here, and here. And again, you could see here, overbought, overbought, overbought. So each of those times we reverted. If it works up slow and gets there and consolidates and isn't overbought or becomes unoverbought, could continue to go forward. Consumer staples, been in a nice little uptrend here since they got back above this important 50 level. And this shows you how this defies science or financial science as well. I mean, why would such a round level be so important in a thing that trades millions of shares a day? I mean, this thing trades 10 million shares a day, and for some reason, the 50 level is important. Why is it not 53.94, or maybe it's because so many retail people or even institutional people like to buy things at nice round levels. But if you really think deeply about it, it's a pretty amazing phenomena. And take a look at this longer term chart. I mean, you can see how 50 was pretty much the exact low in September. And obviously, this is what we just looked at. And basically, all throughout here, all throughout 2015, the 50 level was the top. So obviously, if it rolls over, gets back there at support, that breaks, could see a meaningful sell-off. Energy, too, is another interesting thing with a long-term kind of history. You can see that here they rolled over at the 78 level. Once again, here was a little overbought, rolled over here. Even here, I think this was the 16th, they got to 78 and reverted. And this here is clearly overbought. So that's going to continue to be resistance around 78. 74 will probably still be support. See with support here, here, and it was resistance here. So resistance becomes support, support becomes resistance, as we all know. So keep an eye on that. Look to 74 if it keeps trending lower. But check this out. This is another long-term thing. This is DXLE since 2015, and lo and behold, look at this. Guess where that turned at 78. 78, this is the most recent one. We saw these two on the last chart, but back here in December of 2016, 78 was pretty much the exact high. So that's another one of these amazing phenomena if you think about it. I mean, if you really think about charts the right way, it's really mass psychology. And I get irritated and annoyed when you see these people on TV talking about these crazy things like Gann and Elliott wave. I actually wrote a paper on Gann. I did a lot of research and I read all his books. And Gann was basically, I'm not going to diss the guy because he ran a successful business, but he was basically a stockbroker that didn't do well at becoming a stockbroker. So he started a newsletter, and he didn't do any of the mysterious stuff that you see in his books. Now, as a matter of fact, if Gann himself saw a Gann chart, he wouldn't even know what the hell it was. He wrote a newsletter. I think he has about 5 or 6 books, and I read them all. And he makes some direly wrong predictions too. I mean, he was a really big right winger, and he was writing back during the New Deal, and he hated FDR. And I think when the Dow Jones was at like 136 or something like that, I'd have to look at it. He wrote a letter saying, the market will never go up ever in history past that level again. So I guess his views got swayed by politics, and he thought that the New Deal was going to be a big failure. And I guess he didn't realize in all his supposed insight into the future that World War II was going to come. And, now the Dow Jones is at 24,000, and back then it was at 163. And in one of these really good books that you should read about trading for a living by, I forget his name, but I'll remember it, Trading for a Living by Alexander Endler, I think his name is. He actually interviewed Gann's son, and he said when Gann died, I think it was in the 50s, he had an estate that was worth maybe $1 million or $2 million, which, don't get me wrong, was a significant amount of money back then, and it still is. But it's not the $50 million fortune he's reputed to have. I don't know. Why do people believe in Gann theory? I don't know. Why do people believe in UFOs? Why do people believe in the Loch Ness Monster? I guess just because it's fun. But you're not going to make money off of it. Materials, kind of boring, only 3% of the S&P. Got back above this 58 level, just kind of consolidating, trading sideways. And lastly, we have utilities, and you can see that, in the search for yield here, utilities looked more like a technology stocks here. All right, but we had a big sell-off after this, and the trend was broken. So now we're trading sideways since the uptrend was broken. And again, trend lines aren't mysterious either. This is just a graphical presentation that here the powers of demand are stronger than the powers of supply. The trend breaks, that means they've become equalized. All right, it's not science, it's not mystery, it's not Gann or Elliott wave. It's just common sense. I mean, look, things trade in trends. You don't need to be a market guru to see this. Downtrend, uptrend, downtrend, uptrend. And, there's your trend break. There's your trend break. Each time these trend lines got broken, it told you that the forces were going to change. Here, demand equals supply. Here, demand exceeds supply. Vice versa here and vice versa here. All right, so anyway, that's about it. Let you get back to what you're doing. Hope you have a nice day, and I will be talking with you next week. Thank you. And to summarize, the most important things to watch this week, in my opinion, are how do the XLKs handle this 71 level, and how do financials handle the bottom of the recent range, which is resistance at the 2680 level. This is over 40% of the S&P 500, so clearly it's going to have impact on the broader markets. So that's what I'm going to be watching, and thanks for tuning in, and I guess we'll be speaking again next week.